Okay, so we start now. Yes or no? Okay, see, yesterday we had a discussion about dividends, right? We started with the discussion of dividends. So in dividends we were discussing about deemed dividends, if you remember. So deemed dividends to subsection 22, clause A, distribution of assets to the shareholder. 222B, distribution of debenture stock, deposit certificates to the shareholders, as well as distribution of bonus shares to preference shareholders. That is deemed dividend. Then 222C, distribution of cash or assets on liquidation to the shareholder. Even that is a deemed dividend. Next one, 222D, any distribution, whether cash, assets, at the time of reduction of capital. At the time of reduction of capital is also a deemed dividend. Okay, no? We had a discussion about this. And then last deemed dividend, 222F. 222F, distribution of buyback price. Buyback price at the time of buyback of shares by domestic company to the shareholder. That is also deemed dividend. Yes or no? So this 6 clauses, out of 6 clauses we have already completed 5 clauses. So right now I'm talking about 222E. This is the last clause. Okay, no? See, if a company is there and the company is a closely held company. Closely held company. Earlier deemed dividends, in all those cases, any company was there, any company. Any type of company distributing assets, it is a deemed dividend. Any type of company distributing debenture stock, deposit certificate, deemed dividend. Any type of company distributing bonus shares to the preference shareholders is a deemed dividend. Now this clause will be applicable only if the company is a closely held company. Now what is a closely held company? A company in which public is not substantially interested. Company in which public is not substantially interested. Meaning this company is privately held. Few individuals, they have the control over the company. General public does not have substantial interest. So that type of company is known as closely held company. Yes or no? Now if this closely held company gives loans or advances, to the shareholder, and this shareholder is holding greater than equal to 10% beneficial ownership of shares in this company. So how much shareholding the shareholder is having? 10% or more. So to this type of shareholder, whatever loans and advances will be given by the company, that loan advance will also be treated as what? Deemed dividend. Under section 222E. Understanding? This will be treated as what? Deemed dividend. Because right now the loan or advance is given. Company wanted to give what? Dividend. So instead of giving the amount as dividend, it is given as loan advance. And after some time, after few years, that loan or advance will be written off from the books. So dividend is also given, and loan was also later on written off after some years. Yes or no? So dividend received, nobody paid tax on that. Company can give the dividend like this also. So if any loan or advance is given, see, no matter where the loan or advance had interest, the shareholder was giving the interest also. So this loan or advance may be given with interest or without interest. There is a loan agreement also. This is a bona fide loan. No, we don't want to listen to anything. If any loan or advance given to such type of shareholder, that will be treated as what? Deemed dividend. Yes or no? Okay. Now see, if this shareholder has substantial interest, meaning greater than equal to 20% profit sharing, or greater than equal to 20%, greater than equal to 20% profit sharing, or greater than equal to 20% voting rights in any concern. So this is a concern, business concern. Now this business concern can be, this is a partnership firm, LLP, this can be a company, yes or no? Any business concern is there. But in this business concern, this shareholder is having what? Substantial interest. Now if this company gives what? Loan or advance? Loan or? To such concern also, then this loan or advance is also treated as what? Deemed dividend. This is also treated as what? Deemed dividend. Understanding? Or if the company makes any payment, for the benefit of such shareholder. Which shareholder? This shareholder, this shareholder. For this shareholder also, if the company makes any payments or discharges the liabilities of this shareholder, then this payment made will also be treated as what? Will also be treated as deemed dividend. Understanding or not? So in 222E, 3 points are there. If the loan or advance given directly to the shareholder, it is a deemed dividend. If loan advance given directly to the shareholder, no, it is given to a concern in which that shareholder is having what? Substantial interest. Then also it is a deemed dividend. Or if the company has made any payments, any type of payments, discharges any liabilities, etc., of such shareholder also, then also it will be treated as a deemed dividend in the hands of shareholder. Now see, loan advance, it will be treated as deemed dividend. Loan, advance, payment, yes or no, etc., shall be deemed dividend under section 222E to the extent of what? Accumulated profits as on date of such payment, date of giving the loan, date of making that payment, as on that date, whatever accumulated profits are there, to that extent the loan advance will be treated as what? Deemed dividend. As on the date of making the payment for the shareholder, as on that date, whatever accumulated profits are there, to that extent the payment will be treated as what? Deemed dividend. Understanding? So you have to check what? Accumulated profits. As on which date? As on the date of making the payment. As on that date, whatever accumulated profits are there, to that extent the loan advance given or the payment made will be treated as deemed dividend. Understanding? First thing. Second thing, loan advance shall be deemed as what? Dividend under section 222E only if, what did I say? Only if granting of such loan advance is not substantial part of business of such company or granting of such loan. Granting of such loan is not substantial part of business of such company, or giving advance, or advance is not given in the ordinary course of business. So it will be asked to the company that what is your business? Company, are you in the business of giving loans? Company says, no, I am in the manufacturing business. Then why the bloody hell have you given the loans? Substantial part of business is not giving loans, then why are you giving loans? Then the loan given will be treated as deemed dividend. If the granting of loans by the company is not the substantial part of the business of the company, then the loan will be treated as deemed dividend. Yes or no? Advance is given. Have you given the advance in the ordinary course of business? No. I have just given the advance. If you have not given the advance in the ordinary course of your business, then this advance will be treated as deemed dividend. See, if the granting of loan was substantial part of your business, advance is given in the ordinary course of business, then we are not going to treat it as what? Deemed dividend. But that you have to prove. Yes or no? But if you are not able to prove that granting of loan was substantial part of the business of the company, advance is given in the ordinary course of business, if you are not able to prove it, then 100% this loan or advance will be treated as what? Deemed dividend. Understanding? So, how many clauses we have completed? 6 clauses. Total 6 clauses. 222A, B, C, D, E and F. 222A. Any company distributing assets to the shareholder, then the distribution of asset is a deemed dividend. Fair market value of the asset will be taken as on the date of distribution. That amount will be treated as deemed dividend. But it will be treated as deemed dividend only to the extent of accumulated profits, whether capitalized or not. Understanding? 222B. 222B has 2 parts. Any company giving debenture stock, deposit certificates to any of its shareholder, whether preference or equity, any shareholder, yes or no? Then fair market value of the debenture stock, deposit certificate given as on the date of distribution will be treated as deemed dividend to the extent of accumulated profits, whether capitalized or not. If the company, any company giving bonus shares to the shareholder, which shareholder? Preference shareholder, then giving such bonus shares to the preference shareholder is also deemed dividend. Fair market value of such bonus shares will be treated as deemed dividend. Fair market value as on the date of distribution of bonus shares, yes or no, will be treated as deemed dividend to the extent of accumulated profits, whether capitalized or not. 222B. Okay, 222C. Any cash, any asset, meaning any distribution made at the time of liquidation will also be treated as deemed dividend. If it is given to any shareholder, yes or no? But it will be treated as deemed dividend to the extent of accumulated profits, whether capitalized or not, as on the date of distribution. No. As on the date of liquidation. In 222C, we have to check the accumulated profits as on the date of liquidation. 222D. Any distribution, whether cash, assets, at the time of reduction of capital, by reducing the capital of the company, yes or no, that distribution is also treated as deemed dividend to the extent of accumulated profits, whether capitalized or not. Understanding? But reduction of capital, what did I say? Reduction of capital on buyback, and at that time if any payments are done, if at that time any sum is given to the shareholder in the form of what? Buyback price, etc. Yes or no? That will not be treated as deemed dividend under section 222D. Why? Because it is already taxed under the head capital gain as full value of consideration. Okay. But if a domestic company gives buyback price at the time of buyback to any of its shareholders, then giving such buyback price by the domestic company to such shareholder is now treated as what? Deemed dividend under section 222F. And from this buyback price, there will be no deduction of any cost of acquisition. Yes or no? And in that case, the shareholder will also calculate capital gain under section 46A. At that time, full value of consideration will be nil, and cost of acquisition will be reduced out of capital gain while calculating your capital gain under section 46A. Yes or no? Then 222E, distribution of, giving loans or advance to the shareholder. Which shareholder? A shareholder having 10% or more beneficial ownership of shares, and the loan or advance should be given by a closely held company only. Yes or no? Then that loan or advance will be treated as deemed dividend. If the loan or advance is given to a concern where such shareholder is having a substantial interest, then that loan advance given to such concern will also be treated as deemed dividend. And if the company, closely held company, is making any payments, discharging any liabilities, etc. for the shareholder, then that payment or discharging of liability will also be treated as deemed dividend. Under section 222E, it will be treated as deemed dividend to the extent of accumulated profits as on the date of giving such loans or advance. Yes or no? Or making such payment. And granting of loans is not substantial part of business of the company, and advances are not given in the ordinary course of business of the company, then it will be treated as a deemed dividend. Yes or no? Now see, there is one important point. If loan or advance given to shareholder is treated as what? Deemed dividend under section 222E, and later on such loan advance is adjusted out of dividend. Which dividend? Interim dividend, final dividend. Yes or no? Payable to such shareholder. Then balance dividend after adjustment of such loan or advance shall only be taxable. Now right now the company is giving you loan advance of rupees 5 lakhs. How much loan advance you got? It was treated as your deemed dividend. Yes or no? And later on the company is going to give you a dividend of 15 lakhs. Out of that 15 lakhs, this 5 lakh was adjusted. So later on, how much dividend will be taxable? Full 15 lakhs or only 10 lakhs? Only 10 lakhs, because this loan or advance, which is already considered as a deemed dividend right now, is adjusted from your future dividend. Yes or no? Hello? Is adjusted from your future dividend. Then in future, full 15 lakhs will not be taxable. If that is done, then that 5 lakh will be taxed twice. Understanding? So after adjusting that loan and advance, whatever dividend is given, that dividend only will be taxable, not the entire dividend. Got it, sir? Will you remember this? With this, the concept of dividend is over. Okay, first income we have completed. Read this entire part. Come on, one by one. Read this part. And let me know, we have discussed all these things or not. Explain. Entire thing, no? Do you remember this? Sure? 1, 2, 3. Read this. All these things I had explained yesterday, if you remember. Ramsar, now tell me one thing. Do you know that long-term capital gain is a special income? Why? Because it is taxable at special rates. Short-term capital gain, 111A. Special income, taxable at what rate? Special rates. Yes or no? Salaries, salary income. Is it a special income or a normal income? Taxable at what rate? Normal rates. Sure. House property income. Normal income. Taxable at what rate? PGBP income. Normal income. Taxable at? Just like that, the dividend which you will charge under the head, other sources. All the incomes except few. Okay, no? All the incomes which you are going to charge under the head, IFRS. There are certain exceptions, but all the incomes which you charge under the head, IFRS, are also what? Normal incomes. Taxable at what rates? So dividend will be normal income. Taxable at what rates? Normal rates. But there is one very important thing to remember. Yesterday only I have told you. Higher rate of surcharge. What did I say? Is not applicable. 25% surcharge, 37% surcharge, higher rate of surcharge is not applicable on tax. Which tax? Tax on LTCG 112, tax on LTCG 112A, tax on STCG 111A, and also on dividend income. So whatever tax you are going to calculate on the dividend income, on that tax, higher rate of surcharge will not be applicable. Understanding? That one important thing you are supposed to remember. Rebate you can claim. Rebate you can claim. If your total income is up to 5 lakhs, or if you are in default tax regime, then your total income is up to 12 lakhs. Rebate you can claim up to 12,500, up to 60,000. Rebate you can claim for all taxes except the taxes on special incomes. Do you remember that? The taxes on special incomes cannot be claimed as rebate. Those taxes you are supposed to pay. But other taxes which you are paying, you can claim those taxes as rebate. Yes or no? Hence, the tax on dividend income can be claimed as rebate. Tax on PGBP income, tax on salary income, tax on house property income, the income tax on all the incomes, including dividend income, can be claimed in the form of rebate. Yes or no? But the tax on special incomes cannot be claimed as rebate. Do you remember all those things? Okay. Now see, dividend income taxable at what rates? Normal rates or 115 BSE rates, as the case may be. Okay, no? Chapter 6 deduction not available from LTCG 112, LTCG 112A, STCG 111A, winnings income, then your unexplained income. These 5 incomes I have already told you yesterday, that from these 5 incomes in your GTI you cannot claim chapter 6A deduction. Exclude them from GTI and show that entire income in the total income without taking any chapter 6A deduction. So chapter 6A deduction can be claimed from balanced GTI, and that balanced GTI will also include dividend. So your chapter 6A deduction can be claimed out of your dividend income also. Yes or no? Because this is not a special income. No, this is a normal income taxable at what rates? Normal rates, just like your other incomes. Yes or no? So chapter 6A deduction can be very well claimed out of your dividend income. Higher rate of surcharge 25%, 37%, not applicable on taxes on LTCG 112A, 112, STCG 111A, as well as dividend income. Yes or no? Now see, read this part. This part. Something like this I had explained yesterday. So whatever dividend you are taxing, you are charging under the head IFOS, final dividend, interim dividend, deemed dividend, yes or no? From that dividend, are you going to get deduction for any expense? But you will get deduction for interest on loan up to maximum 20% of your dividend income. But from 222F dividend, which dividend? No deduction will be allowed. No deduction will be not even the cost of the shares. Yes or no? On which you are getting that buyback price. Because that cost you are going to get as a deduction under the head capital gain under section 46A. That will result into a loss over there. Yes or no? So this was your dividend. Deemed dividend 222A, 222B, 222C, 222D, then 222E. All these deemed dividends I have already discussed. These three notes also I have discussed. Okay. And 222F. This is the deemed dividend under section 222F. So along with 222F, you are also supposed to refer capital gain computation under section 46A also. Yes or no? Now see, the first income is over. Out of few incomes which are specifically taxable under the head IFOS. Out of few incomes which are specifically taxable under the head IFOS, one income is dividend. Now second income is, you know, yesterday I made one chart, this list. Dividend income is done, no? Now which income is there? Winnings income. And for this winnings income also, I have already done the discussion with you in the PGVP. Sometimes some casual activities you do, like lottery, gambling, betting, card games, horse races, yes or no? TV game shows, crossword puzzles, these are what? Casual activities. Even online games, yes or no? They are your casual activities. Now what are the casual activities? The activities which have chance of winning or losing. So if you do that activity, either you win or you lose. If you lose, you lose your money. Isn't it a loss? That is a dead loss. For that you are not going to get any set off or carry forward. In the casual activity, on losing, whatever amount is lost is your dead loss. For that you are not going to get any set off or carry forward. But in those casual activities, what if you win? What if you win? You will get a heavy amount. And that heavy amount which you get on winning is known as winnings income. Which income? That winnings income. Whether you do those casual activities sometimes or on a regular basis, will always be taxable under the head IFOS. Understanding? So if you are winnings from, if you are having a winnings income from horse races, taxable as winnings, taxable under the head IFOS. If you are having winnings income from crossword puzzles, betting, gambling, lotteries, yes or no? So from these activities, if you win and you get some income, so that winnings income will always be taxable under the head IFOS. Understanding? And this winnings income which is taxable under the head IFOS, this winnings income which is taxable under the head IFOS, this income, from this income you cannot claim any deduction. No expenses, no losses will be allowed as a deduction out of your winnings income. First point. Second point, set off of any loss. What did I say? Set off of any loss is also not allowed from your winnings income. Number 3, chapter 6A deductions is also not allowed from your winnings income. And number 4, your entire winnings income is a special income. It will be taxable at a special rate of 30%. And where is that rate given? Section 115BB. And if it is an online game and winnings coming from online games, then 115BBJ. 115BBJ, which says that winnings will be taxable at what rate? 30%. So now you are supposed to tell me. Okay. One by one, you are going to tell me. We are talking about which income now? Okay, winnings income, no? So This is as per section 56 subsection 2 clause 1b. So casual activities like betting, gambling, card games, then horse races, lotteries, etc. Okay. They have a chance of win or loss. If win or lose. Okay. So if you lose, loss will happen. That loss is a dead loss. What to do? Set off and carry forward. Allowed or not allowed? Not allowed. Okay. If you win, will you get income? So you will get winnings, income. Somebody is talking continuously. Why? Don't talk, no. Winnings, income. This, out of this winnings, income, whether you do this activity, whether you perform these activities on a regular basis or sometime, will not make any difference. These activities are never treated as business. These are casual activities. The activities having a chance of winning and losing cannot be treated as business. Yes or no? So even if you do these activities on a regular basis, will not make any difference. The income will come to IFOS only. Yes or no? If you do these activities sometimes and you win, then also the income will come under the head IFOS. Yes or no? So the income will be treated as winnings income, and this income will always be taxable under the head income from other sources. Now first important thing, from this winnings income, will you get deduction for expenses and losses incurred in this activity? No. Number two, set off of losses from what? Winnings income. Available, not available? Not available. Number 3, chapter 6a, deductions. Available, not available? Not available. And last but not the least, tax. At what rate? Flat 30%. Under section 115 BB or 115 BBJ. Will you remember this? Sure, sir? Okay. Now see, there is an activity of owning and maintaining racehorse. Do you remember that? That activity will not result into winnings, losing. No, that is a separate type of activity. And from that activity, if you earn some income, even that income is your IFOS income. But that is not a winnings income. That is not a winnings income. Yes or no? From that activity, what type of income you will earn? You will earn stake money. Because you will train your horses, those horses will participate. You have an activity of owning and maintaining racehorse, meaning you are running a stud farm. Yes or no? You are running a horse farm. And in that horse farm, the horses you are training, those horses will participate in races. People will bet money on your horse. That is known as stake money. And if your horse wins the race, first, second, third position, then whatever money people have put a bet on your horse, whatever stake money, yes or no? Out of that stake money you get some share. That is known as income. Stake money which you receive when your horses participate in race and they win. That stake money which you get is your income from that activity. Minus, will you get deduction for expenses? Yes, all the expenses which you are incurring on that activity will be allowed as a deduction under section 57. Understanding? Will you be able to take set off of losses? Yes, even the losses can be set off against that income. Can you take chapter 6a deduction? Yes, because your normal income. And is it taxable at special rate? No, that is taxable at normal rates. Understanding? This differentiation I have done in PGBP also. Understanding? See now, what I am saying, very important discussion. Do you remember in salaries chapter I had told you that whenever the employer will give you salary, employer will have to deduct the TDS. So employer will be deducting TDS on your income and he will give you net income, net salary. Will you charge net salary under the salary head or gross salary? So if net salary is coming after TDS, so you will add TDS amount in your net salary. You will make your salary gross, and that gross salary you are going to tax. That concept is not applicable only for salary. That concept is applicable for all the incomes on which TDS is deducted. So from your winnings also the TDS is deducted sometimes. There are sections. Section 194B, 194BB and 194BB, BA. Okay. So this is a TDS on winnings other than winnings from horse races and online games. Yes or no? This is the TDS on winnings from horse races, and this is the TDS provision on winnings from online games. Understanding? So from your online games, whatever winnings are coming, on that the TDS will be deducted. From your horse races, whatever winnings is coming, on that TDS will be deducted. On all other winnings also the TDS will be deducted. Yes or no? Here the TDS will be deducted if the winnings is more than 10,000. Winnings amount is more than, and here any amount of net winnings. Any amount of net winning. Net winnings means all the platform charges, all the commission, etc., which you pay. Yes or no? So the net amount which you win on those online gaming platforms. Yes or no? Net winnings. Net winnings does not mean after TDS. Net winnings means after adjustment of all the things. Yes or no? So if the winnings is more than 10,000, then the TDS will be deducted at what rate? 30%. And from online games, if your net winnings, any amount of net winnings is there, on that also TDS will be deducted at 30%. Understanding? So this is the provision, TDS provisions. So now say, if you are getting winnings income, will you get winnings income before TDS or after TDS? The person who is going to give you winnings is going to give you winnings amount after deducting the TDS only, no? Yes or no? So after TDS, if you are getting winnings, so how much winnings you are getting? 100% or only 70%? Understanding? Under the head IFOS, how much will you charge? 70% net amount or 100% gross amount? 100% gross amount. Always the gross amount will be taxable. And the TDS which is already deducted, no, later on when you will calculate your tax liability, from your tax liability you are going to get the credit of that TDS. But right now the TDS, your income which got deducted in the form of TDS, you have to show that income also, and the net amount which you have received. So gross amount of winnings you are supposed to show as your income. Understanding? So if TDS is deducted, what did I say? Out of your gross winnings income, if TDS is deducted, you are going to get what? Net winnings. Yes or no? Gross will be 100, TDS will be 30, so net winnings will be 70. Always this gross amount, what did I say? Always this gross amount will be taxable under the head IFOS. So if gross amount is given, directly charge the gross amount. And if net amount is given, then first you gross up. Then after grossing up, whatever gross amount is there, that you are supposed to charge. Will you remember? See, this concept is not applicable only for winnings. This is applicable for salary also. This is applicable for interest also. Wherever the TDS will be deducted out of your income and you are going to get that net income, you will never show net income as your income. You will always show gross income as your income. Yes or no? Everywhere. Understanding? Okay. Now pay attention. Sometimes what happens, now see, for example, your winnings, gross winnings was 10 lakh rupees. How much? Will there be a TDS deducted out of this? How much TDS? If this was 100, so out of that 30% TDS has to be deducted. Yes or no? So the TDS deducted will be 3 lakhs. Okay. So how much net winnings you are going to get? 7 lakhs. That is how much? 70%. So you will receive 7 lakhs in your hands. But how much you will charge under IFRS? Full 10 lakhs. That means the 3 lakh was also your income only, which got deducted in the form of TDS and was paid to the government. So out of your 10 lakh rupees of income, 3 lakh rupees of income got deducted. That does not mean that this 3 lakh is not your income. This 3 lakh is also your income. And the 7 lakh which you have received is also your income. So your income is 10 lakhs. Later on when you will calculate your tax liability, out of your total tax liability, you will get the credit of this 3 lakhs. So this gross you are going to show taxable under the head IFRS, and this net amount, this TDS, okay, no, this TDS amount you are going to take as a credit from your tax liability, full final tax liability. Now see, sometimes what happens, no, that your the person who is giving winnings, might not deduct TDS. He will say that, okay, you have participated in this game show. Have you heard about KBC? KBC means Kaun Banega Crorepati? Amitabh Bachchan is there asking questions. You give the correct answer and you keep on winning some sums. For example, you have participated in KBC and this 10 lakh rupees you are earning from KBC. Now that KBC organizers, they are going to give you winnings income. That TV game show organizers are going to give you 10 lakh rupees. So out of that 10 lakh rupees, they should deduct TDS. But what that game show organizer says, that don't worry, whatever amount you are going to win, that entire amount will give you. We are not going to deduct any TDS. So if you win 10 lakhs, no, directly we'll credit 10 lakh in your bank account. Don't worry, full 10 lakh we are going to give you. Understood or not? Tell me yes or no. Now if you get full 10 lakhs, meaning how much money is coming in your hands? Government will always think that the game show organizer has deducted TDS. Now the game show organizer will have to deposit that TDS. How much they will deduct? How much they will deposit? 3 lakhs. No. Amount will be higher amount. Why? Because the moment the winnings is released, it will be assumed that the TDS is deducted. Moment the winnings is released. See, last time how much winnings was released? 7 lakhs. After TDS. So the amount released was 7 lakh. It was after TDS. 70%. So 30% was 3 lakhs. That was deducted and given to the government. Yes or no? But this time how much is released? So government will say that, okay, you are releasing how much? That is after TDS. That 10 lakh is not 100%, that is 70%. Now will you write 10 lakh over here or you will write 10 lakh over here? Yes, after TDS. After deducting the TDS, you have released that 10 lakhs. Understanding? So now I will write my 10 lakhs here. That is after TDS. So if 10 lakh is after TDS, it is 70%, then how much should be? 30%. Can you class multiply? Multiply. 4 4 lakh? 4 lakh? 570? This much amount that game show organizer will have to deposit from his own pocket. So are you getting one benefit or two benefits? You are getting 10 lakh rupees in your hands also, and your TDS was also paid from the pocket of the game show organizer. Yes or no? So how much total benefit that person is giving you? 10 lakh or 14 lakhs? Simple. 14 lakh, 28, 570. So the government will think that your winnings was not 10 lakh. The winnings was 14 lakh, 28,571. Out of that, 4 lakh 28,571 was deducted, and then 10 lakh was released to you. So under the head IFRS, how much you are going to charge? This you are going to show taxable as your IFRS income. And this tax, which is already deposited to the government, are you going to pay this tax again? So take the credit of this tax. But first, that tax which was deducted and deposited by the TV game show organizer, first you have to show that as your income. So how much income you are going to take? 14 lakh 28,571. And from that, whatever that 4 lakh 28,571 was there, which was paid by the TV game show organizer, which you have already shown as your income, take the credit of that. Simple. Always show gross, and the TDS amount, take the credit. Will you be able to do something like this? If something like this comes in the exam, will you be able to crack it? Sure, no? Now see, sometimes winnings is given in kind. Winnings is given in, so winnings in kind means what? If you are participating in any game, TV game show, etc. So instead of getting money as a winnings, you get something else as your winnings. For example, if you will participate in Fear Factor. Fear Factor is a game show, TV game show. Khatro ke Khiladi, Fear Factor, where few participants are there. They will participate in different types of games. You know, they will, their hands will be tied. They will be thrown in the water. Then 10 keys will be there. Out of those 10 keys, one key will be working key. From that key, you open your lock and then swim and come up. Then they will put you in some basket. In that basket, they will put some snakes, put some cockroaches. Yes, these type of game shows are all there. Fear Factor is there. Then Khatro ke Khiladi. These type of game shows are there. So, for example, if you are participating in that game show and if you win that game show, you are going to get Mercedes. So that amount which you get on winnings is not coming in cash, it is coming in kind. Now what are you going to get as winnings? Mercedes. And what is the value? A car which you are going to get as your winnings, the value of that car is, example, 50 lakhs. How much? So how much is your winnings? 50 lakhs. Yes or no? Will the game show organizer deduct TDS on this winnings? The answer is whether the winnings is given in cash or the winnings is given in kind. The game show organizer has to deduct TDS. So if this 50 lakhs would have been given in cash, he would have deducted how much TDS? 15 lakhs. 30% of 50 lakhs is how much? 15 lakhs. Yes or no? 15 lakhs he would have deducted, and he would have given how much money in your hands? 35 lakhs. Now also you are getting 50 lakh rupees of winning. No, now you are not getting 50 lakh rupees of winnings. Now you are getting a winnings in the form of car, in the form of kind. From this, whether that game show organizer is required to deduct TDS? Yes, on that also you are supposed to deduct TDS. So how that TDS will be deducted? Steering taken out, one seat taken out, music system taken out. Yes or no? The value of the car is 15 lakhs. sorry, 50 lakhs. Out of that 15 lakhs of accessories taken from the car, taken out from the car. Remaining car will be given to you as winnings, net winnings. Yes or no? And these accessories will be given to the government. Government will say, what is this? TDS. TDS will be deducted like this. It is practically not possible to deduct TDS because the amount is not given as winnings. Something in kind is given as a winnings. And the government wants me to deduct TDS on this. How the bloody hell that is possible? So here in this case, the game show organizer will tell the winner that, see, how much is your winnings? 50 lakhs. The car is worth 50 lakhs. And we are required to deduct the TDS and give that TDS to the government. But since the winnings is given in kind, we will not be able to deduct 15 lakhs. So do one thing, that 15 lakhs you need to deposit as your advance tax to the government. So please go and deposit 15 lakhs to the government first. Yes or no? And then show that tax payment receipt to us. Then we are going to release this winnings to you. Then only 50 lakh worth of car will be given. So 50 lakh worth of car is given after you have paid that 15 lakh rupees of advance tax. That means the net winnings is 35 lakhs. Understanding? So in that case, how much will be taxable? 50 lakhs. And the 15 lakh advance tax you have paid will be allowed to you as credit, tax credit from your tax liability. Yes or no? But sometimes what happens that TV game show organizer says that, see, from this 50 lakh, was supposed to be deducted. That is paid in the form of what? Advance tax. So either you pay this tax and show us the receipt, or you give us 15 lakhs, we'll deposit on your behalf. Yes or no? So that is paid in the form of advance tax. This was how much? 100. This was how much? 30. So how much is the balance? 70. 35 lakhs. So that means net 35 lakhs winnings will be there for you. If this is done. If something like this is done. Yes or no? So in that case, how much you are going to show taxable under IFRS? 50 lakhs. And 15 lakhs you are going to take credit from your tax liability. But sometimes that TV game show organizer, what he will do? He will give you the car without you paying advance tax. Did you pay the advance tax? After payment of advance tax, the car is given to you, or without payment of advance tax? Without TDS, yes or no? Government will always think that the car of 50 lakh is released. This is after. So now this 50 lakh is not 100%. Now this is 70%. So will you write 50 lakhs over here, or you will write 50 lakhs over here? Yes. So now that 50 lakhs is net amount. Now that 50 lakh is net amount. That is 70%. So how much should be? 30%. Cross multiply. How much? 857. So how much is 100%? 71 lakhs 42,857. Gross amount of winnings will be 71 lakhs. This will be shown taxable under the head IFRS. And for this, you are going to get credit. Understood? Will you remember? Perfect. This is the end of winnings. Let's see. Can you see casual incomes? Like winnings from lotteries, crossword puzzles, races, including horse races, card games, or other games of any sort, gambling, betting, etc. And also, I am writing, and also from online money games. Online money games like Rummy Circle, MPL, Dream 11, yes or no? These are all online money games. Okay. So shall be fully taxable under the head IFRS. So this type of winnings will be fully taxable under the head IFRS. Under section 115 BB and 115 BBJ. The casual income or winnings income shall be taxable at what rate? 30%. Out of the casual winnings, out of the casual winnings or winnings income, yes or no? Deduction for any expense or loss, allowed or not allowed? Set off of any loss, allowed or not allowed? Deduction under chapter 6A, allowed or not allowed? Further, as per the provisions of section 194B, 194BB, and one more section, 194BA. Okay, your winnings income is liable for what? TDS, if the amount of such winning exceed 10,000. Hence, if net amount of such income, that is, after TDS amount is given, then it must be first grossed up, and such gross amount of winnings, that is, before TDS, shall be chargeable under the head IFRS. If net winnings is given, add TDS amount, make it gross, and that gross amount will be taxable under the head IFRS. Okay, TDS under section 194BA. Net winnings from online games shall also be taxable as income under the head IFRS. Same is subject to tax at the rate of 30% under 115 BBJ, without deduction for any expense or loss and without set off of any loss against the same. Also, the deduction under chapter 6A are not available against such winnings. Everything I have discussed. Okay. So the second income, which was that income? Winnings income. In this list, second income was winnings income. We have completed that income also. And this third income, no, 1C. I've already told you this income, this type of income under the head PGBP. How come salary? This type of income, read. Amount deducted from salary of employee as employee's contribution to staff welfare funds or scheme, if not taxable under the head PGBP, will be taxable under the head IFRS. This type of income I have already explained under the head PGBP. So what is that income? Pay attention. What is that income? See, this is the assessee. We are doing which section first? 56 subsection 2, clause 1C. Okay. So this clause says that assessee is there. Assessee can be any person. Okay. Any person. And now this assessee is giving what? Now this assessee is giving salary. For example, this assessee is giving salary. What is giving? Salary. Salary to the employee. But out of that salary, he is going to deduct what? Salary will be given to whom? Employee. Yes or no? Salary will be given to employee. But from that salary, this employer has to deduct some amounts. What amount? No, TDS, VDS is done. Huh? Now we are not talking about that TDS and all. But for you, provident fund contribution has to be made. So I am making PF contribution. For you, pension contribution has to be done. Contribution to pension fund. Yes or no? Different staff welfare funds and schemes are there. So I am also making the contribution for you. Bloody you also have to make contribution for yourself, no? So from where you will make the contribution? From your salary only. So I'm giving you salary. From that you will make the contribution. No. You will spend the entire salary, bloody. So before giving you full amount of salary, what I am going to do? From your salary, I will deduct some amount as your contribution to your staff welfare funds or schemes. Yes or no? So from your salary, amount is deducted. Amount deducted towards what? Staff welfare schemes or fund as employees contribution. Employees contribution from employees salary is deducted. Yes or no? And after deducting this amount, net salary, what did I say? Net salary will be given to whom? To the employee. He will receive net salary. So your employee has some gross salary. From that gross salary, some amount you are deducting. Now after deducting that amount, are you keeping that amount with yourself? Yes, you are keeping that amount with yourself. Understanding what I am trying to tell you? So amount which got deducted, that amount you are keeping with yourself, and the net amount you are going to give to the employee. So the amount which you are deducting is nothing but your income. From your employee's salary, whatever amount is deducted and kept by you, that you are going to deposit this amount in your employee's fund or employee's scheme. So till the time you have not deposited, that is your income. That is your, and usually this amount will be taxable under the head PGBP. If you did this in the course of your business or profession. So in the course of your business or profession, whatever employees were there, from those employees' salary, have you deducted any amount? Yes. As employees' contribution? Yes. Then that amount which has been deducted by you as employees' contribution from his salary will be treated as your income in the course of business or profession, will be taxable under the head PGBP. And when you later on actually deposit that amount in the staff welfare fund or scheme, that time you are going to get the deduction for that amount. 36 subsection 1 clause 5A. But you have to deposit that amount on or before the statutory due date of that fund or scheme. So what was the due date to deposit that amount in that fund or scheme? As per the law, statutory due date. On or before that due date, if you deposit that amount, then that amount will be allowed as a deduction. So first that amount is considered as your income. Deposit that amount, take the deduction of that amount. Yes or no? Income, and then same amount will be allowed as a deduction. Understanding? This we have already done under PGBP head. 36 subsection 1 clause 5A. But what if the assessee is not engaged in any business or profession? Possible, no? Assessee is not doing any business or profession, and still the assessee will have some employees. Still he will deduct some amount as employees contribution. Then will it be treated as your PGBP income? No, this cannot be taxed under the head PGBP because it is not deducted from employee's salary in the course of business or profession. So this amount will not be treated as income under the head PGBP. So this amount will be taxable under the head IFOS. As per which section? 56 subsection 2 clause 1C. And now later on, whenever you deposit that amount, yes or no, this amount which you have deducted, this amount which you have deducted is deposited in respective staff welfare scheme or fund. So this deposit has to be made on or before what? Statutory due date of that fund. Yes or no? Then this amount will be allowed. Amount deposited will be allowed as deduction under section 57 under the head IFOS. Why? Because it was considered as your IFOS income. So now you deposit that amount, then claim it as a deduction under the head IFOS. But you have to make sure that you deposit on or before the statutory due date of that fund or scheme. This is 56 subsection 2 clause 1C. Will you remember this? Okay, next one now. Now next income. We are going to discuss 56 subsection 2 clause 1D and 56 subsection 2 clause 8 and 56 1. Three sections we are going to discuss together. And wait. And we are going to discuss about some exemptions also. Now see, as per this section, some interest is taxable under the head IFOS only. As per this section also, some interest is taxable under the head IFOS. This interest will be taxable only under the head IFOS. This interest will be taxable only under the head IFOS. Specific charge. So because of specific charge, some interest is taxable under this head. Because of general charge also, some interest can be taxable here. Because of general charge also some interest will be taxable here. But because of section 10, some interest will be exempt also. So we are going to discuss about all the interests. The interest which is taxable under the head IFOS because of specific charge. The interest which is taxable under the head IFOS because of general charge. And those interests also which are exempt as per section 10. Yes or no? So exemption is given for certain interest. Now what is this interest? Come on, tell me. This interest is interest on securities. Interest on securities. The interest on securities will be taxable under the head IFOS. Interest on securities will be taxable under the head, if not taxable under the head PGBP. So if you cannot charge that interest under the head PGBP, then that interest will be taxable under the head IFOS only. Specific charge is there. When can you charge your interest under the head PGBP? Can you charge your interest on securities under PGBP? Yes. Interest on securities will be taxable under the head PGBP if you are in the investment business. Your business is to invest and trade in securities. So your business is to invest and trade in securities. You are buying and selling the securities and you are earning interest income. Along with the buying and selling, you are also in the business of earning the interest income. So securities will be held by you as stock in trade. Securities, I am not talking about shares. Shares even if held as securities. Shares even if held as stock in trade. The dividend on shares will always come under the head IFRS. But that is not the case with securities. If the securities are held as stock in trade, buying and selling of those securities will give you PGBP income, but also the interest income of that securities will be taxable under the head PGBP. But if the securities are not held as stock in trade, you are not in the investment business, you are not in the business of earning such interest, buying and selling the security, then you cannot charge this interest under the head PGBP, then this interest will always come under the head IFOS. Will you remember this? Now, clause 8 talks about interest on compensation. Interest on what? Compensation or enhanced compensation. Enhanced compensation on compulsory acquisition of capital asset under any law. This interest will always be taxable under the head IFRS. For example, the government decided to compulsorily acquire your capital asset. In the year 22-23, which year? Your asset was compulsorily acquired. Are you going to get the compensation in the same year? Not necessary. You might get compensation in 25-26. Bloody the compulsory acquisition took place in 22-23. You should have got that compensation in 22-23 only, but the government paid you compensation late in this year. So will you get the compensation? Yes. Compensation was decided that you are going to get 50 lakhs. How much? But along with the compensation, government gave you interest for 22-23 also, 23-24 also, 24-25 also, and for some time of 25-26 also. So for how many years you are receiving interest? 22-23, 23-24, 24-25, and some part of 25-26 till the time you are not getting that compensation. Yes or no? Now tell me, for these many years, the total interest was 5 lakhs. So this time, how much amount you received from the government? Did you receive 50 lakhs or 55 lakhs? In that 55 lakhs, 50 lakh was the compensation amount. 50 lakh was that is the consideration for transfer of your asset, will be taxable under the head capital gains. 45.5. Do you remember? Full value of consideration, amount of compensation, initial compensation will be taxable under the head capital gains. Yes or no? But what about that extra 5 lakhs? Was that your compensation? Was it a consideration for transfer of your asset? No. Consideration for transfer of asset was only 50 lakhs that you have shown under the head capital gain. But that extra 5 lakh which is coming is not a consideration for transfer of asset. So that cannot be taxable under the head capital gain. And that interest is of capital nature. That is an interest. That interest is of capital nature. So first of all, that interest is also your income. Any capital receipt is not an income till the time it is specifically made income. So first of all, in the definition of income, this type of interest is covered because this is capital receipt. This type of interest you don't get on a regular basis, just like your normal interest. Yes or no? So this interest is a capital receipt. First, it is treated as your income. It was covered by the definition of income, 2 subsection 24. The term income includes this, the income includes, the term income includes this. In that list of income, definition of income, in that list, this interest is also covered. Now this interest is your income. And we want to charge this income under the head IFRS as per clause 8. Specifically, this interest will be taxable under the head IFRS. You are not happy with the compensation, so you filed a case to enhance your compensation. Can you file the case? And the case came in your favor. The court said that compensation should be enhanced to 60 lakhs. How much was the compensation? 50. Enhanced to? So additional compensation, enhanced compensation is 10 lakhs. 10 lakh you are going to get right now or later on? Later on, no. So on that enhanced compensation also you might get interest for these many years. So can you get interest on compensation? Can you get interest on enhanced compensation? That interest is your income as per 224 definition of income. Yes or no? That interest is your income. And that interest we want to charge under the head IFRS 56 subsection 2 clause 8. And that interest will be taxable on receipt basis. Which basis? Irrespective of the method of accounting you are following. Meaning, if you are following mercantile system of accounting, which system? So you will say interest of this year I will tax. Interest of any earlier year received by me in this year, I will not charge because that interest is not relating to this year. Can you speak these things? The answer is no. For whatever your interest you are receiving in this year will be taxable in this year. On what basis? Receipt basis. For chargeability of this interest, you are not supposed to see method of accounting. Will always be taxable on what basis? Always taxable on receipt basis. Yes or no? And from this interest, you are going to get a standard deduction under section 57. How much standard deduction you know? 50% of such interest. Because even the government knows that charging this type of interest is not a good thing to do. Ultimately, it is our mistake that we are doing compulsory acquisition. That time we are not giving compensation. The assessee did not tell us to give the compensation late. That is our mistake that we are giving late. And for that delay in paying the compensation, we are giving interest. That interest the assessee never demanded from us. So that is for our mistake we are giving interest, and that interest we are giving and charging that interest under the Income Tax Act. This is not a justifiable thing to do. Still we are doing it. So we will not become that bad to charge the entire income. We will charge the entire income, but we will give 50% standard deduction. So entire interest will be taxable? Yes. But out of that you are going to get 50% standard deduction under section 57. So under the head salary, you had a standard deduction from your entire salary income. Yes or no? Under the head house property, you had standard deduction from entire house property income of that house property. Yes or no? But under this head, you have standard deduction only from this income. Yes or no? And one more income is going to come later on. Are you understanding what I am trying to tell? So standard deduction will be allowed at the rate of 50% of that interest. And this interest will be taxable on receipt basis, irrespective of your method of accounting. All the incomes under the head IFOS will be taxable based on your method of accounting, but not your dividend. Dividend is taxable as per section 8. Final dividend taxable in which year? In the year of declaration. Interim dividend taxable in which year? In the year of receipt. Deemed dividend will be taxable in which year? In the year in which it is distributed or paid, as the case may be. Interest on compensation or enhanced compensation taxable in which year? In the year of receipt, on receipt basis. Yes or no? Now, for how many years you have received the interest? For 4 years. So you cannot say that the interest which is not related to this year, I will not charge. Why? Because I am following mercantile system. I will charge interest only for this year. No, you don't have that option. This interest will always be taxable on receipt basis. So last 3 years or 4 years interest also you have received in this year, that interest will also be taxable in this year, even if you are following mercantile system of accounting. Will not give any importance to the method of accounting. Will always be taxable on what basis? So how much interest you was getting? 5 lakhs. Out of that 5 lakh, 1 lakh 20,000 is relating to first year. 1 lakh is relating to second year. Some interest is relating to third year. So likewise the breakup of 5 lakhs is given. So out of this 5 lakhs, some interest relating to 22-23 will be taxable in this year only, receipt basis. Out of this 5 lakh, some interest is relating to 23-24 will be taxable in this year only on receipt basis. Yes or no? Some interest is relating to 24-25 will be taxable in this year only. And the interest for this year is also going to be taxable in this year. Always on receipt basis. Will you remember this? Okay. Now, some interest is taxable under this head. But there is no specific charge. Because of general charge, you have to charge that interest under the head IFOS. Now, for example, interest on loans or advances given. Can you give loans and advances to someone? Tell me yes or no. That on that, will you get interest? Are you in the business of earning such interest? No. So definitely, if you are not a bank, not in the business of lending money, then the money which was given by you as a loan or advance to someone, on that, if you are going to get interest, that interest has to be taxed under the head IFOS, because you are not in the business of giving loans or advances. And that interest cannot be charged under the head salary, under the head house property, under the head PGBP, under the head capital gain. That interest is not an exempt income. So interest, is it your exempt income? This interest is not exempt. Can you charge this interest under any of the earlier 4 heads? No. So because of general charge, this interest will be taxable under the head IFOS. Now, can you, this is one interest, yes or no? Another interest is interest on deposits. Interest on those deposits you can keep with any company. You can keep these deposits with banks, yes or no? Deposits with government or post office, etc. So any deposit, especially bank deposit. For example, you are keeping a deposit in a bank, savings deposit in a bank. So on that savings deposit, are you going to get interest? Yes, taxable under the head IFOS. You are keeping a fixed deposit in a bank. On that fixed deposit, are you going to get interest? Yes, taxable under the head IFOS. You are keeping some company deposits. You are depositing your money with some big public limited company in the company deposit. Yes or no? Are you going to get interest? Yes, taxable under the head IFOS. Because that interest is not exempted. So I am talking about that interest which is not exempt under the Income Tax Act. And two, that interest is not taxable under any of the earlier four heads. So definitely that interest will be taxable under the head IFRS because of general charge 56(1). Understanding or not? Now, can you receive interest on IT refund, income tax refund? Can you get income tax refund from the government? How come? In the assessment year, you come to know that the tax liability of your previous year was 2 lakhs. So you were supposed to pay how much tax? 2 lakhs. But you have paid 2,50,000. Have you paid excess tax? How much? Will you claim it as a refund? That will come with interest. So a refund, government refunded how much, you know? 53,000. How much? So 50,000 plus 50,000, which is your income tax refund, is not your income, because income tax paid extra is coming back to you, is not your income. But with that 3,000 extra is coming, that 3,000 is your income. Is it exempt anywhere? No. Is it taxable under any of the earlier four heads? No. So will be taxable under the head IFRS because of general charge. See, these two interests will be taxable under the head IFRS because of specific charge. But the interest 1, 2, 3, these three types of interest which I have discussed with you right now are also taxable under the head IFRS. But there is no specific charge. Still they are taxable under the head IFRS. Why? Because of general charge. Because these interests are not exempt. No exemption for this type of interest is given in Income Tax Act. If you will check section number 10, you will not find out these type of interests. Getting my point? So the interest is not exempt under, these three interest is not exempt under Income Tax Act. Number two, you cannot charge these interest under any of the earlier four heads of income. So definitely the general charge of IFRS will be invoked, and because of that general charge, these interests will be taxable under the head IFRS. Understanding? Now there are certain interests given in section number 10 which will be exempt. So this is a very important point which I am going to discuss with you now. Which interests are exempt under section 10? And if that interest is exempt, bloody, you are charging that interest under IFRS or any other head, you are a fool. Bloody fool. Take some water, jump inside. They are saying that clearly this interest is what? Exempt. As per section 10, exemption is given for this interest, and still you are charging that interest under IFRS or any other head. You are a fool. Hello? So which interest? You have to remember those interests. Because if you will not know that which interest is exempt, by mistake, you will be charging those interests. So please carry a water bottle with you in the exam. But after coming out of your exam, no, then only you will come to know. In the exam you will not know. Exam, drink that water, but save something. After coming out of the exam, take some water and jump. So I am telling you some interest. Which interest? Exempt interest. Yes or no? See, for this, I am creating a note below. Yes or no? Star. Interest exempt. Exempt interests. Exempt interests. Now which interest? First of all, interest on specified investments or securities. So there are certain investments or securities which are specified. On those specified securities and investments, if you are getting interest, if you are getting that interest will be exempt. That interest will be, and that will be exempt under section 10 subsection 15. So as per 10:15, in section 10:15 only, the name of those investment, name of those securities are given. So if you invest in any of those securities, any of those investments, you have invested your money, yes or no? And on that, if the interest is coming, that interest will be fully exempt as per section 10:15. You are going to get interest on PPF account, Public Provident Fund account. You might have heard about this in salaries chapter. So any interest credited in PPF account is fully exempt under section 10:11. So no need to charge this interest also under the head IFOS or any other head. Yes or no? Interest you can earn on Sukanya Samriddhi account, which is opened under Sukanya Samriddhi scheme, SSS, Sukanya Samriddhi scheme. So central government scheme is there. The name of that scheme is Sukanya Samriddhi scheme. In that Sukanya Samriddhi scheme, if you open an account on the name of your girl child, this scheme is for the benefit of your girl child. Okay, no? So if you have a girl child, you are the parent of that girl child, or you are a legal guardian of that girl child. So do one thing, open a Sukanya Samriddhi account on the name of your girl child. First, deposit some amount in that Sukanya Samriddhi account. The amount deposited in that account will be allowed as a deduction under ATC, because that is an investment in the Sukanya Samriddhi account for your girl child. So whatever investment you will make in this scheme, in this account for your Sukanya, meaning girl child in Sanskrit, girl child, small child is known as Sukanya. So when you invest, meaning when you deposit in this account in this year for your girl child, for that deposit, for that investment, you are going to get deduction under ATC. On a regular basis, interest will be credited in that account. Just like the way you deposit money in your bank account. So on that bank account deposit, the bank will give you interest on a regular basis, no? Interest will be credited. Just like that, interest will be credited on a regular basis in the Sukanya Samriddhi account. Yes or no? And that interest credit every year happening in the Sukanya Samriddhi account is fully exempt under section 1011A. Which section? 1011A. And likewise, every year deposit allowed under section ATC. Interest credited fully exempt. Every year deposit allowed under section ATC. Interest fully exempt. This will happen till Sukanya becomes Kanya. She grows up, okay, and she attains the age of majority. Now when she will grow up, at that time, for her further studies, for her marriage, etc., the money will be required. And thank God, you have this Sukanya Samriddhi account in which you have been depositing the money. Now a good amount of money will be accumulated in this Sukanya Samriddhi account, will be taken out of Sukanya Samriddhi account for the benefit of this girl child who has now grown up. It will be used for the marriage. It will be used for the higher education of this girl child. Yes or no? So that way the government wants to secure the future of female child. Yes or no? Understanding? So whenever that amount will be withdrawn, lump sum amount out of that Sukanya Samriddhi account will come. Yes or no? At that time also, that lump sum payment from Sukanya Samriddhi account will be fully exempt under section 1011A. So every year keep on depositing and take the deduction under ATC. Yes or no? And every year interest will be credited. Hello? And that interest will be fully exempt. Understanding? And at the time of maturity of this account, the money, the lump sum money, that is the total amount deposited, total interest credited for these many years, yes or no? So the total amount, accumulated amount will come at the time of maturity of this account. And that accumulated amount coming at the time of maturity will also be fully exempt under section 10(11). So in the Sukanya Samriddhi account, deposit made, allowed under section 80C. Interest credited, fully exempt. And the amount coming as a lump sum on maturity of Sukanya Samriddhi account, fully exempt. Just like that, PPF account is also there. Every year, deposit money in the PPF account will be allowed as a deduction under 80C. Interest will be credited every year. Yes or no? Will be fully exempt under section 10(11). And the limit of PPF account is 15 years. After 15 years, the PPF account will mature. So today, if you are opening that account will mature after 15 years from today. Yes or no? So on maturity, whatever amounts you have deposited in PPF account, whatever interest which have been credited for these many years, that entire lump sum will come on maturity from PPF account. That time also it will be fully exempt. So every year amount deposited, allowed under 80C. Every year interest credited, fully exempt under section 10(11). And at the time of maturity, the amount of lump sum, these many years, whatever amount deposited, these many years, whatever interest credited, that entire lump sum will come on maturity. That time also it will be fully exempt under section 10(11). So I hope these 2 points you understood. Yes or no? Now I am going to talk about 10(15). You have to learn the name of these investments or security. You have to remember these names. So if you see interest on any of these specified securities or investments, where the investments or securities are specified, they are specified in section 10(15) only. On these investments, on these securities, if you are going to get interest, that interest is also fully exempt. So which are those investments? Which are those securities? If you know the names, definitely instead of investing somewhere else, you will be motivated to invest in these type of securities. So the government wants you to invest in these type of securities. Hence, the government is giving you benefit that if you will invest somewhere else and you will get interest, that interest will be taxable. But if you will invest in these type of securities, these type of investments you will make, on that whatever interest is coming, that interest we will exempt. So the government wants to motivate you. Government wants to promote people to invest in these type of securities. Okay? Wafa, if you are feeling sleepy, then go home. No need to sit here like this. Am I teaching like this? Don't behave in such a kiddish way, huh? This is a classroom, not your home. Understood this one? Okay, pay attention. IFOS. In this, 1C I have already discussed this point. Okay. Coming to interest income. Did I discuss this one? Interest on what? Like debenture, bonds, government securities. Any debenture you have, any bonds you have, any government securities you have, on that whatever interest is going to come, that will be taxable under the head IFOS only, if it is not taxable under the head PGBP. Refer note 1. Interest on securities held as will be taxable under the head because you are in the business of buying and selling the securities and earning the interest income. So that way, whatever securities are held by you as a stock in trade, on that whatever interest will come, that will go to PGBP. But if you are not in the business of buying and selling the securities, earning the interest income, then that will be your investment, and on that whatever interest is coming, that will be taxable under the head IFOS. Will you remember this? Okay. Now note number 2, interest on enhanced compensation. Interest on compensation or enhanced compensation. I have discussed this entire point. Okay, no? This entire point with example I have discussed. Read at home today. Next one, interest on following specified securities or investments. See, this is done, and this is also done. Okay, This is taxable as per general charge. Interest on income tax refund also taxable. Yes or no? And now I am discussing this part. Fully exempt under section 1015. Please check. Interest on gold bonds. I have already told you in capital gains. Gold bonds, gold deposit bonds. Yes or no? So if you are having gold bonds, gold deposit bonds. Yes or no? Gold deposit certificates. On these gold bonds, gold deposit bonds or gold deposit certificates in which you have invested, will you get any interest? Yes. First of all, they are not your capital asset. If you will transfer, capital gain will not arise. And second, interest on these bonds also, gold bonds, gold deposit certificates will also be fully exempt. That time only I have told you. But remember, sovereign gold bonds are not excluded. They are your capital assets. If you will transfer sovereign gold bonds, capital gain will arise. But wait, sovereign gold bond transferred at the time of maturity by an individual is an exempt transfer. That time capital gain will not arise. In any other case, the capital gain will arise because sovereign gold bond is a capital asset. And if you receive any interest on sovereign gold bond, nowhere it is mentioned that the interest is exempt. 1015, interest on sovereign gold bond will be exempt. No, it is not given in 1015. Then interest on sovereign gold bond, exempt or not exempt? Not exempt. So interest income is not exempt. Can you charge it under any of the earlier four heads? No. So definitely that interest will be taxable under the head IFRS as per general charge. Yes or no? So read the note. Interest on sovereign gold bonds shall be taxable as IFRS, shall not be exempt under 1015. And this is taxable as per general charge. Yes or no? Next one, if you have national savings annuity certificate. See, the gold bonds and everything will be issued by government. These national savings annuity certificate, national defense gold bond, then national plan certificates, these will be issued by government. So whatever securities and investments you are seeing, no, are all government. So if you put your money here, if you invest your money here, the money is going to government. And government wants you to invest your money here. So that if you will invest your money here, ultimately, directly or indirectly, the money will go to the government. Government will be able to use that money. And to get that money from you for using, the government is giving you benefit. So that you keep on investing in such things and government keep on getting such type of money from you. Yes or no? So national savings certificate, no. National savings annuity certificate. There are two types of certificate. One is national savings certificates. Another one is national savings annuity certificate. I am talking about national savings annuity certificate, or you have invested in national defense gold bonds, or you have invested in national plan certificates, or you have invested in national plan savings certificate. So any investment made by you here, on that investment if you are going to get any interest, that interest will be fully exempt. Fully. But sir, if you are investing in national savings certificate, one word is missing. Yes. So these are not annuity certificates. The money which you are going to invest, that entire money will come back to you in lump sum. Yes or no? But in national savings annuity certificate, what happens? The money which you invest will be given in the form of annuity on the maturity. So first give your money to the government to buy what? National savings annuity certificate. Then whatever money you have given to the government will be returned on maturity, but in the form of annuity. Annuity means fixed payments on regular basis. So that is national savings annuity certificate. On that, if the interest is coming, that interest will be fully exempt. But national savings certificates, the money which you are going to give to the government, the money which you are going to invest right now, that money will come back to you on maturity in lump sum, not in the form of annuity. So what is the beauty of NSC, you know? Beauty is when you invest money in your NSC, National Savings Certificates. So the government issues the National Savings Certificates on a periodic basis. Whenever the government is in need of money, government will bring an issue of National Savings Certificates. Okay. So now, if you have invested in any NSC, National Savings Certificate, so the money which you invest, money which you deposit today will be allowed as a deduction under section 80C today. Now forget about that money for 15 years. Because maturity of NSC will happen after. So just give your money to the government right now, deposit your money, invest your money today in this year in NSC. Whatever amount you have deposited in NSC this year it will be allowed as a deduction under 80C. Now forget about that money for next 15 years. Because NSC will mature after 15 years. After 15 years you are going to get this money back. So definitely, if you are not in requirement of any funds for the next 15 years, then only invest here. Now what benefit you will get? Benefit will be every year your interest will be compounded. Compounded like what? First year interest on the principal amount, the main amount which you have invested, principal amount, yes or no? First year interest, what will be the tax treatment for that? It is your income, nowhere exempt. So it will be taxable. And for the second year, along with your principal, it will be reinvested in your NSC only. So first year if you have given 1 lakh rupees and the interest was example 10,000. So 10,000, which is the accrued interest for the first year, will not be given in your hands. What will happen? That will be reinvested as your investment for second year. So now your second year investment will be 1 lakh plus 10,000, principal will be 1,10,000. On that you are going to get second year interest. Now for example, second year interest you are going to get 11,000. How much? So that 11,000 will not be given to you in the second year. That is accrued interest. That will be reinvested for the third year. So now in the third year of principal will be 1,10,000 plus 11,000, 1,21,000. On that you will get third year interest. Likewise, every year interest will accrue and will be reinvested in NSC. Will accrue and will be reinvested in NSC. By the end of 15 years, no, you will get more than twice of the amount which you had actually deposited. Because of that compounding. Getting my point, what I am trying to tell you? Hello? So, tell me one thing. Every year interest will accrue. That accrued interest is exempt? No. Interest only on National Savings Annuity Certificate is exempt. Accrued interest on NSC will be exempt, nowhere it is written. Meaning, it will be taxable. It will be taxable as your IFOS. Every year, whatever interest accrues, that will be taxable. Under the head? And since that interest again gets reinvested in your NSC, every year that interest will also be allowed as a deduction under 80C. So first consider that amount as your taxable IFOS income. And since that income gets reinvested for the next year, yes or no, in your NSC only, take the deduction of that under section 80C. So first year interest was 10,000, taxable under the IFOS, and take that 10,000 under 80C. Second year interest was 11,000, taxable under the head IFOS, and take it as a deduction under 80C. Likewise, you are going to do for how many years? 14 years. Year 1 to year 14. Year 15 you cannot do that. Why? Because year 15 whatever interest will be there, that interest will be taxable as IFOS. But since it will not be reinvested for the 16th year, because after 15 years, the NSC will mature and that interest will come back in your hands. That is not going to be reinvested for the 16th year. So in the last year, you will not get any deduction under 80C. And that entire interest for the last year, which will not be a small amount, it will be a huge amount of interest, will be taxable at once in the last year. Government is very smart. They could have directly given the exemption. No, sir, taxing every year and then giving the same amount as a deduction, it is as good as exemption. Yes, it is as good as exemption. The government could have given the direct exemption. If directly they would have said that this entire interest is what? then they would have to exempt the interest of the last year also, which they did not want to do, because last year interest will be the highest interest, and that interest the government wants to charge. And how that will be, they will be able to charge? They cannot say no, that first 14 years we will give the exemption, last 15th year we will not give the exemption. Everyone will come to know, oh, last year when I'll be having the highest amount of interest, that interest you want to charge. So everyone will be skeptical. Everyone will come to know that last year interest government wants to charge. So what the government will say? No, no, we'll charge it from the first year only. We'll charge it from the first year. It is not like that we are going to charge the interest for the last year only. No, no. All the years interest. Year 1 to year 15. All the years interest will be taxable as your IFRS income. We are not going to give any exemption. But since your amount of interest again gets reinvested for NSC, no, in the next year, we are going to give you the deduction under ATC. So you said, wow, interest it will be considered as my income for the first year. Sorry, income for the year. Then since it is getting reinvested, so I will get the deduction under ATC. It is as good as exempt. So you did it for 14 years. Taxable deduction. Taxable deduction. When the last year when you raised, interest got taxable. And when you asked for the deduction, they said, no deduction. Why? Because we were giving deduction, assuming that it is getting reinvested in your NSC, but your 15th year interest is not getting reinvested in NSC, so we are not going to give you any deduction. That way they are going to charge. Nobody will ever come to know that why we are doing it. First taxable, then deduction. First taxable, then deduction. We could have directly given you the exemption, but in that case, we would have to give you the exemption for the 15th year interest also. That we don't want to give. Hence the tax treatment like this. Understood everyone? So, what are you going to do? Come on, tell me. What are you going to do? Accrued interest on what? On NSC, National Savings Certificates. Okay. And this treatment which you are going to give, this treatment is from year 1 to year 14. First 14 years. Yes or no? Every year interest will accrue, will be taxable under the head IFOS. And that interest, since it is getting reinvested for next year, will be allowed as a deduction under section. But wait. First year, the actual amount invested by you will be allowed as a deduction under ATC. First year, you are putting how much amount? 1 lakh. That 1 lakh will be allowed as a deduction under ATC. And then from later on, first year interest, second year interest, which is getting accrued, that accrued interest will also be allowed as a deduction under ATC. But for that, first it has to be treated as your taxable income under the head IFRS. Last year, when you will get your money back, 15th year, after the expiry of 15th year, will you get the entire amount? The 1 lakh which you originally invested, and every year interest, that lump sum amount you are going to get once after 15 years, yes or no? Fully exempt. But out of that, only the interest for 15th year will be taxable. Understanding? Yes or no? So for year 15, year number 15, whatever is the interest, what are you going to do? Taxable as IFOS, but for that you cannot take deduction under ATC. Will you remember this? Sure, sir? Okay. Now, next is, you have invested in national relief bonds, state relief bonds, RBI relief bonds. Then in those relief bonds, if you have invested, and on that you are going to get interest. That interest is also fully exempt. You have invested in special bearer bonds. Remember the definition of capital asset, exclusions, last exclusion, special bearer bonds, not a capital asset, no capital gain will arise. And on that special bearer bonds, whatever interest also will come, that will also be fully exempt under section 10 subsection 15. Yes or no? Then treasury savings deposit certificates issued by the RBI on behalf of Central government. So you are investing in treasury savings deposit certificates. Whatever investment made by you in these type of certificates, on that whatever interest will come will be fully exempt. Then you are investing in 7% capital investment bonds. These bonds are also issued by the government. Yes or no? Which bonds? 7% capital investment bonds. Then interest on these bonds also will be fully exempt. Then bonds which are issued by local authority or any state pooled finance entity. So if some local authority is there, some state pooled finance entity is there, they are issuing some bonds. You are purchasing those bonds. On those bonds also, if you are going to get any interest, that interest will also be fully exempt. Then this is an important point. Post office cumulative time deposit account, post office cash certificates, and post office savings deposit account. Did I write etc. over here? Only these three investments in post office. Only these three investments in post office. Post office cumulative time deposit account, post office cash certificates, and post office savings deposit account. If you have invested your money in any of these schemes of the post office, and on that if you are going to get interest, that interest will be fully exempt. But wait, if you are investing in post office savings deposit account, where are you depositing your money? Have you opened a savings account in a bank? If you are opening a savings deposit account in a bank or a cooperative bank, on that savings account whatever interest will come, that will be fully taxable. Yes or no? But if you have opened a savings deposit account with a post office, hello, go to any post office. Right now also you can open these type of savings account in any post office. Go to the post office and tell the post office that post office, I want to open a savings account with you. So post office will ask that why do you want to open a savings account with us? You can open a savings account with a bank or a cooperative bank also, no? So what will you tell? If I will open a savings account with a bank or a cooperative bank, they will give me what? Interest. That will be my taxable income under the head. First of all, the interest will also be very less, and that interest will also be taxable. So I am coming to you because the rate of interest usually offered on post office savings account is little bit higher. And also the interest which you are going to give me will be exempt. Earlier this interest used to be fully exempt. But few years back now, they have put a restriction that interest on post office savings account will be exempt under section 1015, fully exempt if the amount is 3,500 or less per annum. So for the full year, the total interest received by you is 3,500 or less. It will be fully exempt. See, if the account was a joint account, then the limit will be 7,000, not 3,500. For the full year, the interest on the savings account should be 3,500, 7,000. As the case may be, or less, then the interest will be fully exempt. But if that interest is more than 3,500 for the year, more than 7,000 for the year, then up to 3,500 or 7,000 you can take the exemption. Excess interest will now be taxable under the head IFRS because of general charge, because that interest is not exempt. See, all the interest which we are talking in section 15 are fully exempt, whatever may be the amount of that interest. Yes or no? 2,000, 5,000, 10,000, 50,000, whatever amount you are going to receive as interest will be fully exempt. But restriction only on one interest. Which interest? Interest on post office savings deposit account. That interest for the full year up to 3,500 it will be exempt. If it is received more, then up to 3,500 exempt and excess will be taxable. But if the post office savings deposit account is not on your individual name, it is on the joint name, you're jointly holding that account, yes or no? Then on that joint account, which account? Post office savings account, jointly held, yes or no? On that account, whatever interest will come, that interest will be exempt up to 7,000. Up to 7,000 fully exempt, and excess amount will be taxable as IFRS, if any. So this is the limit for full year. Now tell me, if I am having a post office savings account on my name, and this year the total interest I am getting from that account is 2,300, fully exempt, nothing will be taxable. Why? Because the interest is up to 3,000. Very important point. In almost, I'm telling you, every 2 or 3 attempts they ask you this point in the exam, and students commit mistake in this point. So 2,300 fully exempt. What if for the full year I'm getting an interest of 4,900? 3,500 will be exempt. Excess is 1,400. That will be taxable as my IFRS. If the account is jointly held. So if the account is jointly held by me and my father. Wait. First, let me ask the question. Now the post office savings account is a joint account. Is it only my account held on my individual name? Or me and my father, we both are the joint holders of that account? Yes or no? On that account, the total interest for this year is 6,900. Fully exempt? Sure. No problem if it is fully exempt. But first of all, tell me that 6,900 interest is coming. That interest will be the income of me or my father, or for both? Father? Sir, father, because he is your father. My income or my father's income, or the income for both? Sir, some income to you, some income for you, some income for your father. Out of 6,900, some amount will be your income, some amount will be your income of your father. No, it will not happen. This entire 6,900 will be income of any one holder, any one person. Either it will be treated as my income or it will be treated as my father's income. Whose income? Yes. The primary account holder, the main account holder, first account holder. So whenever you will open that account in the post office, anywhere, even in the case of FD also, if you keep some FD in the bank and that FD is jointly held, then FD interest will not be the income for both the joint holders. It will be the income of primary account holder. If you have any savings account in a bank and that saving account is jointly held, then who will be in whose hands the income of that joint account will be taxable? Always primary holder. Always because whenever you open a joint account, account opening form will be given. So you fill up that form. And if you want to keep that account only on your name, then there is no problem only. But if you want to keep that account, if you want to hold that account jointly with someone, so you have to be very careful that whose name you are giving as a primary, main or first account holder. So the first account holder, meaning the primary account holder, will be the person in whose hands this amount will be treated as income. So while filling up that form, I gave my name as primary account holder and my father's name as a secondary account holder. Second account holder. Yes or no? Then who is the primary account holder? Sir, entire 6,900 will be my income. Now tell me, this 6,900 will be taxable or will not be taxable? Fully exempt, because the amount is less than 7,000. What if the amount is 8,900? 8,900 is my income because I am the primary account holder. Yes or no? But out of that, 7,000 will be exempt and remaining 1,900 will be taxable for me because I am a primary account holder. Understanding? Sure. What if you are getting income from post office monthly income scheme? Check the names. Did you see post office monthly income scheme? So whatever income is coming will be fully taxable. only the post office cumulative time deposit account, post office cash certificates, and post office savings deposit account. Interest on these items, these investments will only be exempt. Any other investment made, any other deposit made in the post office, on that if you are going to get any interest, that will be taxable. Getting my point? Understanding? Now there are certain notified what? Bonds or debentures of any public sector company. Wait. Which company? Public sector company. What is the meaning of public sector company? All the public limited companies are not public sector companies. First of all, public sector company has to be a public limited company. But all the public limited companies are not public sector companies. Public limited companies means the companies in which, public limited company and private limited company. Public sector company means a company in which the controlling shares are held by government. 51% or more shareholding is with the government. So any public limited company, what did I say? Any public limited company in which majority of the shareholding is with government. 51% or more shares are held by government. That company is known as public sector company. But sometimes a public limited company is a private sector company also. Have you heard about Reliance? Reliance is a public limited company, but it is in private sector because the government is not owning 51% or more shares of that company. Tata, have you heard about Tata? Tata is what? Public limited company, but it is a private sector. So I am talking about which public limited company? The public limited company which comes in the public sector. So any public sector company subject to certain conditions, yes or no? You have invested in the bonds and debenture. Which bonds and debentures? Notified bonds and debentures of notified public sector companies. So which are the companies and which debentures are notified? Which bonds and debentures are notified for which companies? So they are saying that tax-free bonds which are issued by India Infrastructure Company Limited. This is a public sector company. You will have to remember these all names, yes or no? India Infrastructure Company Limited. Whatever tax-free bonds issued by this company, you have invested in these tax-free bonds. So interest on that tax-free bonds will be fully exempt. Interest is tax-free. Meaning what? Interest is exempt. That is why the name of the bonds is tax-free bonds. Yes or no? Then tax-free. The name only suggests that these bonds, whatever interest will come, will be tax-free. But the bonds will be secured. The bonds will be redeemable. They will be non-convertible. So whatever bonds which are issued right now, they will be tax-free bonds. But they are secured, redeemable, non-convertible bonds of IRFC, NHAI, RECL, HUDCO, PFC, JNPT, Dredging Corporation, Ennore Port, yes or no? IREDL. I hope you might have seen these names somewhere. Somewhere you have seen these names. How many names are there? 6 names, no? 1, 2, 3, 4, 5, 6. You have seen these names. Where you have seen? Capital gain exemption under section 54 EC. So if you invest the amount in these bonds, that investment will allow you to take the exemption under 54 EC. And also whatever interest will come will be fully exempt. So take the exemption of your capital gain based on this investment, and also interest on these bonds will be fully exempt. No TDS on these interest also, because interest itself is exempt income. Why TDS? TDS is always deducted on your taxable incomes. Yes or no? So is it a taxable income? No. All these exempt incomes, all these exempt interest, TDS is never deducted. TDS is always deducted on taxable interest. So there are provisions under TDS for interest also. From interest also the TDS will be deducted. Some TDS will be deducted under 193, some TDS will be deducted under 194A, and the rate of TDS is 10%. So if you are getting any taxable interest, from that taxable interest, the payer will deduct TDS and give you the net interest. How much interest you are going to get? 100% or only 90%? 90%, because 10% is the rate of TDS. So for example, you are getting taxable interest on securities, other interest, yes or no? So there are TDS provisions. TDS provisions under 193, 194A. As per these provisions, certain interest which are taxable interest which you are going to receive, on those TDS will be deducted. How much TDS? Under 193, under 194A, 10%. What is the rate of TDS? 10%. On winnings, what is the rate of TDS? 30%. But on interest, what is the rate of TDS? 10%. So the payer who is giving you taxable interest will deduct 10% TDS and will give you full 100% or only 90%. But under the head IFOS, how much you are going to show? 100%. Grossing up has to be done for interest also. But there are certain interests which are exempt only, no? The income which is exempt in your hands, you are not supposed to pay tax on that income. Will there be any TDS on that? No. So those interests will come fully in your hands without any TDS. Yes or no? So these interests which we are talking right now, which are exempt incomes, on them there will be no TDS. Full amount of interest will come, but that full amount of interest will be fully exempt. No need to show them taxable also. Understanding? And especially if you are having these type of bonds, if you have invested in these type of bonds, IR, DEAL and HUDCO, these two bonds have been newly inserted in 54EC from this year. So don't be surprised if you see these two names in your question paper this time. In capital gains chapter, they will tell you to calculate the capital gain of immobile property, long-term gain. And then they will tell you out of this long-term gain, some amount is invested in bonds. Bonds of HUDCO and IRDEL. What is the full form? Indian Renewable Energy Development Agency Limited. Okay, no? And what is the full form of HUDCO? Housing and Urban Development Corporation Limited. Getting my point? So if these two bonds you are investing, investment is allowed as a exemption under 54EC. But whenever you will get the interest on these bonds, any of these bonds, that will be fully exempt. Done, sir? Next one. Deposit of money due on retirement or superannuation with the government of India by an employee of CGSG public sector company in accordance with the notified deposit scheme. Tell me. Notified deposit scheme. Don't read this part. Read this only. This only. Come on, tell me. What did you understand? You are an employee. Employee of central government, state government or a public sector company. You are retiring in this year. So on your retirement, on your superannuation in this year, are you going to get some money? Retirement benefits. So that is the money due. That is the money due on your retirement or superannuation, meaning your retirement benefits. Are you going to get this amount, small amounts or big amounts? Because this is your retirement money. This will be a big amount. After so many years of your employment, you are going to get these amounts as your retirement money. So is there any money due on your retirement or superannuation? Hello, employee. Are you the employee of central government? Yes. State government? Yes. Public sector company? Yes. You are going to retire in this year. So on your retirement, some monies are due, like gratuity, commuted pension, leave encashment, yes or no, balance from ASAF account. There are many retirement benefits. So that is the money due on your retirement, which you are going to get from the government, because you are the employee of government. So that money which is due on retirement is going to come to you from employer. Who is your employer? Government. Now don't you think this is not a small amount, this is a big amount? This is a, after 20 years, 30 years when you will retire, no, few crores of rupees you are going to get as what? Retirement money. Now just imagine, if you will take that money from the government, that much money will reduce from the government account. So the government wants you not to take this money on retirement from us. So the money which was due, if you will take that money with you, okay, then that much money will be reduced from the government's exchequer. So what the government is saying? If you are not in need of this money, which is due on your retirement, then why are you taking this money from us? Keep this money deposited in the notified scheme of the government only. See, the money which was becoming due was how much? 5 crores. How much? So if you want, take 1 crore. But remaining 4 crores, if you don't want, then why are you taking that 4 crores? Keep that 4 crores deposited with the government in notified government schemes. And on those deposits, we are going to give you good amount of interest. And that interest we are going to fully exempt. So what you will think? Anyways, if I would have, see, 4 crores I don't want right now. Okay. Out of 5, I want only 1 crore to build my house, for my daughter's marriage, this and that. Okay, no, that 1 crore I will take. Remaining 4 crores, if I'm not in requirement of that money, so what will I do? I'll get that 4 crores, then I will invest it somewhere. That investment will give me returns. That will be my income, which will be taxable. So instead of having that money, investing anywhere else, keep that money safe with the government in some deposit account. The government is going to give me good amount of interest on that, and that interest is nothing but return, which will be fully exempt. If I would have invested this 4 crore somewhere else, might be my principal was at risk. I might not get that much amount of interest. Yes or no? So instead of that, putting my money at risk, not getting proper returns, and even if the returns are coming, getting taxable, let me put my money safe, because it is deposited in any scheme of the government. Money will be safe. Number 2, guaranteed returns will come, and that return will be in the form of interest, which will be comparatively higher, and the government is also going to give me exemptions. So you will be motivated to keep your money there only with the government. That much money will be saved. That much outflow will be saved from the government. To save the outflow, the government is going to give you this type of benefit. Getting my point? So are you getting any interest? That interest is on money due, which you have deposited with the government in any government scheme, notified schemes. Yes or no? So any deposit of money due on retirement or superannuation with the government of India by an employee of CG, SG or public sector company in accordance with the notified deposit scheme, even that interest will be fully exempt. Now see, did I tell you interest on PPF account fully exempt? Did I tell you interest on Sukanya Samriddhi account fully exempt? Now remember one more interest on NRE account. Interest on. So in my list here, I will write down interest on what? NRE account. This will be fully exempt under section 10 subsection 4. So NRE account means non-resident external account. Which account? See, there are non-residents living outside India. NRIs. You know na NRI? NRI is a non-resident Indian, meaning he is an Indian only. But is he staying in India? No, he is staying outside India. And he might be earning in foreign currency good amount. Software engineers are there, doctors are there, professionals are there. Since so many years they have settled outside India. Yes or no? And they are earning good amount of money in foreign currency. So we are attracting them to deposit their foreign currency in a bank account in India, in NRE accounts. So open a NRE account in India with any approved bank. You can open this account, and in this account you can deposit your foreign currency here with us. on that foreign currency deposits which you will make in this NRE account, whatever amount of interest you are going to get, that interest will be fully exempt. That interest will be fully exempt. Why? Government wants to promote the NRIs to come and invest their foreign currency, come and deposit their foreign currency in these type of accounts and keep those foreign currencies in this account for longer period of time so that the foreign currency reserves increase in India. Understanding? Who can open this account? Can you go and open this account? Why? Because you are not a NRI. Can I open? Even I cannot open. This is NRE account which is specifically made for persons resident outside India as per FEMA, Foreign Exchange Management Act, usually known as NRIs. And also those persons who are specifically approved by the RBI to open such accounts. So who will open this account? Any individual, any who is a NRI, or this account will be opened by that individual who is given a specific approval by the RBI to open such account, can open these type of accounts, and in these type of accounts they will deposit their foreign currency. Foreign currency deposits will be made. On those foreign currency deposits, whatever interest will come, that interest will be fully exempt. Will you remember? So now these four interests, please remember, very, very, very important. Okay, whenever you see these four interests, it will be exempt. Other than this interest, if the interest is on loan or advance, taxable under the head IFRS. Interest on company deposit, taxable under the head IFRS. Interest on bank deposits like FD, savings deposit, recurring deposit. Interest on any post office deposits, yes or no, will be taxable. Interest on compensation or enhanced compensation, taxable. Interest on securities, taxable, yes or no? So this was the interest point. Did you understand, everyone? Read the note number 4 and read note number 5. Did I explain something like this? Sure. Interest, taxable interest will come to you. It will come after TDS. How much TDS will be deducted? 10%. So we'll get how much? 90%. So under the IFRS, taxable interest will be 90% only, no? Or full 100%. Grossing up concept will be applicable here also. Yes or no? Full interest will show taxable, and the TDS which was deducted on interest will be later on allowed as a tax credit from your tax liability. Understood, sir? Okay. From rental income. See, this rental income. Okay. From this part we are going to continue after the break. Okay. Take a small break and we are meeting after the break and we'll continue from here. Okay. Today we are going to finish this chapter. Don't worry. Okay.